Good afternoon, participants, and welcome to today's webinar. Today's webinar is about blended finance for agricultural development, organized by both the Alliance of Green Revolution in Africa and African Guarantee Fund. We have five speakers for today. We have Ms. Hedwig Celestine, who is the head of Inclusive Finance Unit at AGRA. We have Mr. Frank Ajaba, the Group Director, Business Development, African Guarantee Fund. Then we have three technical, we have Ezra Anyango, the Senior Program Officer at AGRA, who is looking at blended finance instruments. We have Dr. Rufaro Madakaze, a Senior Program Officer as well at AGRA, who will talk to us about extension and capacity building, the SME technical support that we offer. We have Mr. Patrick Lumumba, a Senior Capacity Development Officer at African Guarantee Fund. Before we begin, this is to inform you that the session will be recorded, and you type in your questions as we move that will be answered during the question and answer session. So to start us off with our opening remarks, I welcome Hedwig Celestine, the Head of Inclusive Finance at AGRA. Welcome.
Thank you, Alfred, and welcome everybody to this webinar on blended finance, which is a co-production of AGRA and AGF, where I will start by introducing AGRA. So AGRA exists to improve the yields and income of smallholder farmers in Africa. Currently, we work in 14 countries, which you can see on the map, plus Togo, Zambia, and Ivory Coast. We have the target of reaching 30 million farming households by 2022 by helping them to improve their yields and income. Improving yields and income will, of course, require improved seeds, improved soil practices, extension, access to markets, access to inputs, agro dealerships. But today we're going to talk about access to finance. So how do farmers get access to finance, and how do SMEs that service the farmers, that buy from farmers, that sell to farmers, how do they get access to finance? And how do countries or banks or funding institutions or investment funds come to their funding? Next slide. So in AGRA, agricultural finance is one core topic within all the work we do, because all the work we do to promote improved inputs and to help farmers get access to markets also require finance. So if we look on the right-hand side, we see farmers. We think that farmers can get access to finance from rural financial institutions and agricultural SMEs. So that's the ones you see on the left hand of that circle. We do that by promoting digital finance. So we help rural financial institutions and agricultural SMEs to digitize so that they can reach farmers cheaper and with less risk, because they're collecting data on farmers. So all we do is about reducing cost and risk of agricultural finance. So in order to reach farmers cheaper and less risky, we promote digital finance. We have invested in 23 digital solutions across Ghana, Kenya, Tanzania, and Rwanda to help farmers to get access to finance. In the middle box, you see the area of work which we call value chain finance. There we try to help banks to develop appropriate products for agricultural SMEs and rural financial institutions so that they can fund farmers. So what do we do with banks? We help them to develop appropriate products where risks are shared among other people apart from the banks. Because agriculture is different from any other sector in that it has much more risks, and that is often more expensive to reach farmers because they're all scattered and dispersed through the countries. So in the middle area, we work with banks and with agricultural SMEs and rural financial institutions to see how the risks can be shared and how through digitization costs can be reduced of agricultural finance. Now today we're going to talk about the left-hand circle. So I won't go in details into that because my colleagues will take you through all the aspects related to blended finance. But in blended finance, the idea is that we get more money into the banks and the funds that have the appropriate risk and cost profile so that banks and funds can fund SMEs and farmers in the end sustainably. So that is the topic of today. How can we get more money into the system with the right risk and return profile so that banks can do business? In everything AGRA does, we need partners because AGRA cannot do everything alone. And we have found in African Guarantee Fund an excellent partner to work on blended finance. So we are very happy that today we can present to you the work we are doing with African Guarantee Fund in getting more finance into agriculture. Thank you. Back to AGRA. To Alfred.
Thank you, Hedwig, for that introduction. Next, we have Mr. Frank Ajaba, the Group Director, Business Development at the African Guarantee Fund. Welcome, Frank.
Thank you, Alfred, for having me. Good afternoon to all our guests. African Guarantee Fund is a pan-African AA minor rated guarantee scheme, and our focus is to promote access to finance for Africa's small and medium-sized enterprises. And agriculture and agribusiness accounts for 32% of GDP in sub-Saharan Africa and employs 65% of the workforce. As such, it is likely to have a bigger impact on poverty reduction than other sectors, as it offers the most direct routes of raising return to poor people main assets. And that asset are land and labor. So this is why for African Guarantee Fund, improving access to finance for SMEs in agriculture was made a key priority. As at December 2019, for example, USD 188 million of loans were granted to over 2,000 SMEs in different agricultural value chain by AGF's partners. So being the predominant sector in Africa, agriculture has the potential to create thousands of farm and off-farm jobs across the different value chains. And this contributes to job creation and poverty reduction in Africa. And that are two key development outcomes we are expecting to achieve at African Guarantee Fund. Therefore, in partnership with different stakeholders, and specifically with AGRA, AGF will put more efforts in promoting the agriculture sector with the objective of increasing our exposure in this sector. So, like most of the SMEs, the financing challenges faced by the farmers is the result of the following gaps. We have what we call information gap, collateral gap, the gap in the tenure, the skills gap, the product gap, and the perception gap. So through our blended finance model of guarantee products and our capacity development services, we are addressing all these gaps by supporting financial institutions as well as SMEs. And my colleague Patrick will elaborate on how AGF bridges all these gaps during this interesting session. So I'll stop here and I will wish you a fruitful session. Back to you, Alfred.
Thanks so much, Frank. We have had in blended finance, what we're looking at is how do we address the issue of risk and how do we ensure that money flows to agriculture. Now, to talk to us about the technical element of blended finance, risk-sharing facilities, and TA support, we have Mr. Ezra Anyango, who is a Senior Program Officer at AGRA. Welcome, Ezra.
Thank you, Alfred, and welcome everyone from East Africa. It's a good afternoon. From West Africa, I think it is still morning. And for others who are in different parts of the world, you're welcome to this blended finance webinar. We would like to share AGRA's experience in blended finance and share the reason why we have a partnership with the African Guarantee Fund in this arrangement. Go to the next slide. Yeah, as has been mentioned before by the first speakers, I will quickly go through the issues that are facing agri-SMEs and smallholder farmers in accessing finance. I think it has been indicated that risks associated with the sector key issues which relate to seasonality of agriculture and predictable markets and limited collateral. Another key issue is the cost of delivery. Because this area is diverse and we have small transactions, you have lower scales in terms of supply side and also on the demand side. The cost of delivery is usually very high. And so we look at how do we encounter these, how do we come up with programs that address the issues of risk and cost of delivery. Next slide. We've identified a number of gaps in interventions that governments have made in the past to address the issue of financing agriculture. Governments generally use subsidized funds to finance agriculture. However, you find that the government funds that have been put forward to financing agriculture is insufficient. For example, if you look at Malawi, they spend almost 70% of their budget on agricultural budget for input financing, denying the government opportunity to spend in other things where pressing needs. And the national development finance institutions that have been created by the governments to deliver on this, again, usually lack both human and financial capability to finance agriculture. So as a result, public resources that have been put to do this in terms of guarantee funds and others have usually been underutilized or not properly utilized because they are not leveraged. Now, the public sector, in our view, the public sector can provide a very important incentive to address this situation in terms of leveraging, as you see in the next slide. Next slide. Yeah, blended finance can be used to provide incentives to help address this situation. And what is blended finance? Maybe I should not assume that everybody on this webinar understands what blended finance is, because it's a new term that has been used quite recently. We, as two organizations, also with OECD, there is a definition that blended finance is a strategic use of development finance or philanthropic funds to mobilize private capital flows into the particular markets that we're trying to address, including agriculture and to address development issues. So blending finance is bringing concessionary. Go to the next slide. Next slide. Yes, blending finance is using concessionary public funds to actually leverage private sector capital into the sector. And therefore, you end up with blended finance structures. Blended finance structures, therefore, look at the issues of cost, they look at the issues of risk, and they look at the cost, or they look at the issues of getting a bigger pot of funds to be able to deliver to the sector. Next slide. Next slide. Yes, our experience in this area, and I'm going to speak more because blended finance, as my colleague Patrick will be talking about, different structures and different avenues that are using blended finance. But as AGRA, I'll be speaking particularly to those that we have worked with directly, and where we have, I'm going to share some of our experience and some of the areas that we have already got what you call a proof of concept. And in de-risking instruments, we have worked with the guarantee funds in risk-sharing facilities to actually do leveraging. We have also worked with credit facilities, which usually for microfinance institutions that lack capacity to have sufficient liquidity. And then, of course, a very key important area is technical assistance. And the technical assistance is the one that actually facilitates the process of delivering, whether the credit, whether it's a guarantee fund. And then we have also experience with what we call enablers that support guarantee funds within certain organizations. For example, in Ghana, we have worked with GIRSO, which does bank rating scheme, bank incentives, and of course, my colleague has talked about digital financial services. And so I will be sharing some of our experience in these areas, but specifically what we have gathered in the area where we have managed guarantees as well as technical assistance. Next slide. What are some of the lessons that we've learned, the evidence that we have already got in terms of using the blended finance model? Our experience with technical assistance and guarantee funds in Kenya and in Ghana, we have developed models. We have developed models that enable banks to lend to private sector SMEs and smallholder farmers conveniently and to lend them profitably. In Rwanda and Ethiopia, we are assisting them to develop risk-sharing facility frameworks. And of course, we are in a partnership with funds, which we are leveraging over 250 million, using our 5 million again to bring funds into the sector. What are some of the outcomes and that we have so far gathered? We have developed a proof of concept. We've realized that government using blended finance can actually unlock funding from the private sector. Government does not have to fund everything itself. Government can bring in resources that will leverage private sector, create an incentive for private sector to come in. But in order to do this, technical assistance in terms of introduction of products, in terms of looking at staff development, training, and new business models is absolutely critical for blended finance tools to work well, for example, in guarantees. And we can give sample results that we have gathered so far in Kenya. We worked with 2 financial institutions. We worked with Agricultural Finance Corporation. We've worked with Barclays Bank, and we have also worked with 4 microfinance institutions. In our experience, in just about 2 years, we found that we were able to leverage almost 4.75, almost 5 times from the private sector using funds that were sourced from the government of Kenya as well as from a partner called IFAD. In Ghana, we are working with an organization that is already enlisted 12 financial institutions, and in just 1 year has already leveraged 2 times. So again, what we are saying here is that government or concessionary funds should not be used to address the issues themselves, but should be used to catalyze the sector, should be used to actually leverage more funding and also to reduce the costs of running the blended finance. And of course, AGF will be sharing quite a bit. The experience, I have talked about our experience. This shows that loan disbursements that we had with AFC was about 6 times what we gave them, up to 23 million in 2 years, and with Barclays about 10 million. This is just a sample of what we did in just under 2 years. One key issue here is that the PAR, I know that most of you understand this if you're in the sector, but portfolio at risk at AFC, we were able to significantly reduce portfolio at risk to a level where it is acceptable. Next slide. Next slide. Yeah, so what are our proposals? We are actually proposing that we enter into partnerships with organizations like the African Guarantee Fund. Why do we want to enter a partnership with the organization like African Guarantee Fund? Because they are sustainable. That is the business that they have been set up to do. But our role is catalytic. We work with institutions, we develop models. These models that we develop, we can then share and then link them to a fund that is already up and running. Therefore, our role as AGRA is not to create funds and start running them, but to create models that are sustainable, models that can be picked up by private sector and they can run with. We also partner with governments and DFIs in designing tools and designing models to engage regulators, providing evidence to regulators so that they can see that evidence that we provide is sufficient for them to use guarantee funds for de-risking. Next slide. And that is our experience in this particular sector. My colleague, Rufaro, is going to talk about our capacity building in this particular sector. And of course, Patrick will be talking more about the guarantee schemes that we partner with them. Thank you for listening. And of course, we welcome questions and we'll be able to address them bilaterally or on this platform.
Thank you very much, Ezra. To the participants, please type in your questions in the question box provided. Key points noted here is that blended finance is a mix between public or concessionary funds that are meant to unlock private capital to lend into the sector. One of the lessons that I think we've learned with time is that technical assistance is quite critical for both the supply side and the demand side. So how do you ensure that the demand side is bankable enough to attract this funding that is being provided? Now, next on the speaker line, we have Dr. Rufaro Madakaze. She is the Senior Program Officer, Extension and Capacity Building at AGRA, who will talk to us more about SME capacity building. Welcome, Dr. Rufaro.
Thank you so much, Alfred. Thank you so much, Ezra, for starting off the technical discussion. AGRA works with a lot of SMEs, from micro, small, and medium-sized enterprises. And the definition of the SMEs really is based on the number of employees, the sales turnovers, the loan sizes they give. In general, when we are talking of micro SMEs, they are not registered, they are small, they are informal, and the SMEs are formal businesses that are maybe registered. in the continent, 65% of the food in Africa passes actually through the hands of SMEs. So their role, I think, as Frank from AGF has highlighted, is critical. And they are also critical in sustainably delivering improved technologies and markets to smallholder farmers. And below is just the types of the SMEs, the micros, the small and the medium enterprises, classified according to the numbers of employees, the total assets, annual sales, and the loan sizes that they can garner. Next slide, please. So since 2006, AGRA has created and worked with agri-SMEs as key enablers for inclusive agriculture transformation. We've worked with seed companies, making sure that they produce good quality seed of improved varieties. We've worked with agro dealers, making sure that they grow enough to provide access to the inputs close to the farmers. We've worked with grain handlers, ensuring the market for smallholder farmers. And AGRA has done three key things in working with the SMEs. We have built the capacity of the SMEs through business development services, different types, technical assistance, training courses, linkages across the board. And we have also worked on ensuring that the SMEs access finance. And we've also worked on ensuring that the policies and regulations are good and enable the small SMEs to thrive. But next slide, please. But the issue really on all the SMEs across the board, it doesn't matter whether it's seeds or it's fertilizer or it's grain handling, there are serious capacity gaps in the SMEs, from the micro to even to the medium enterprises. There is weak management capacity, poor record keeping. Sometimes the records are kept, but even when the records are kept, they do not know what to do with the records. You have the records, but you don't use the records to actually decide or determine what to do next. Poor monitoring of the exercise of the activities, little or no planning, no budgeting, limited or no HR and admin systems in place, and there's poor product quality. And a lot of the times we think they should know, but sometimes they just don't know. It's poor product quality because there's lack of knowledge. There's also lack of flexibility to adapt if there are changes. It's difficult for them to change and to say, okay, this product is not working, let's try another product and quickly package and work to develop the business. There's lack of research capacity to understand the needs of the markets, limited marketing skills. The range of the gaps is quite big, and it's fairly similar in all the systems. So I'm going to discuss three different models that we have used in AGRA to build capacity of SMEs. We've been focusing on SMEs because SMEs are almost like the bridge to reach the smallholder farmers with all kinds of technologies that are needed. AGRA worked with the seeds companies, and I was part of the seed program for about 10 years. We funded seed companies. We gave them small grants of about $150,000 to increase their production, to increase access to seeds of improved varieties. But then we realized there were serious capacity gaps, so we hired these high-tech consultants from the US, from India, from Europe that came to work with the seed companies. And they worked with them, but they realized there were serious baseline training needs that were needed. So from that, we actually funded the establishment of the Seed Enterprise Management System Institute, where people worked in the seed companies, from seed production managers, processing managers, marketing managers. The owners of the business would come for 1 to 2 week courses that were very practical to learn about some of the critical things they needed to run their businesses. And after that, for some of the still weaker SMEs, we still send some consultants, lower level consultants from Africa, who would work with the seed companies for about 6 months, for a season, because the problems were so critical and so many. Some of them would actually start working with the companies from identifying the products that they need to work on, identifying the markets, establishing the systems in the place, and working with them on a day-to-day basis. And this has really helped. And of course, we continue to have technical assistance by AGRA experts that provide ongoing mentoring and field visits to ensure that the companies grow. We've worked with about 147 seed companies, funded 114 of them, trained 1,200 seed company personnel. And these people ranged from all kinds of people. We refused to train only the managers or the owners of the businesses, because sometimes you train the owner of the business and they are not the ones who do the work. And they have been able to access loans of about 15.5 million from Pearl Capital, Injaro, and Root Capital that Ezra talked about. And 5 of these companies have grown big enough to reach about 10,000 metric tons of seeds per annum. Next slide, please. So this is the first model that we talked about. And as I said, the training was very practical. This is some of the pictures from the training on seed production. The participants visited seed companies. They worked with the KFIS on seed quality. How do you ensure quality? And so the courses were very practical. In the business courses, they had case studies, they had scenarios, they had all kinds of things that actually got them thinking. By the time they left, like the marketing course, they were actually had developed a marketing plan for their companies. That's how practical the courses were. Next slide, please. Next slide. So the second model, so the first model, it was managed by AGRA mainly, especially for the consultants bit. The second model was the business development models used for grain handling and market-related SMEs. This was used to build the capacity of all kinds of SMEs in the marketing space, and the interventions include capacity development, they included training, they included mentoring, they included coaching, support to the SMEs, business development, marketing, HR and admin. They also included technical assistance by the BDS providers, financial management, all those things. But what we did was AGRA, we actually funded the BDS providers to support the SMEs. And these are all the services they did. And we did this in several countries. For example, in Uganda, we worked with the Uganda UDET, what is it called? Uganda Development Trust, to build the capacity of about 50 SMEs. And from those, 23 of them actually were linked to financial institutions, and 18 received funding from those institutions. Just a few examples, we have Numa Feeds, which received training on enterprise development by an organization funded by UNDP. After the training, UDET actually went in and provided BDS support to them, and the company has started to grow. We also have Upland Rice. They had approached UDET to assist them to build to access finance, but when UDET started working with them, they realized there were some gaps in some of their knowledge, in some of their management techniques. So they actually went in and started handholding and working with the management and the business to make sure that they have all the systems in place. So that's the kind of work that we have done. The next slide, and the next example, which Ezra is also alluded to, is Profit, which was done in Kenya. This had a primary objective of building capacity of selected SMEs in value chains to mentor them and link them to markets. These SMEs were, as I said, from the market space. A needs assessment was conducted, and they developed 6 training courses based on these need assessments that included entrepreneurship, business planning, financial planning, access to finance, insurance for agriculture, gender mainstreaming. And from the work that they did, actually 283 of the SMEs were mentored. They were helped to develop business plans, with 151 of them able to access finance. They got finance of about 4.42 million US dollars. So the systems have worked. The main thing here is that in this second level is AGRA funded specific BDS providers to help the SMEs. The last example I'm going to use, next slide, please. Next slide. The last example I'm going to use, the slides are taking a bit longer to come, is where we worked with SMEs within consortia. I'll give an example of Mozambique. In Mozambique, there are 2 consortia that we worked with. One in Nacala corridor and one in Beira corridor. With this consortia, they worked with all kinds of partners. The consortia in AGRA had seed companies, fertilizer companies, agro dealers, marketers, extension people, and some NGOs to provide training. So what the NGOs in these consortia did was to build the capacity of the SMEs that were in those consortia. They actually provided similar services to the ones that we were talking about earlier, build capacity in business planning, in financial planning, linked them to finance, we helped in product development, and facilitated business-to-business meetings in the consortia that enabled easier sourcing of the products and markets. This actually enabled cross-learning of the participants. It also linked people so much within the consortia that even as small as businesses, as small as the VBAs, knew where to market, knew where to source products that they needed. Next slide, please. So our key lessons learned in this SME capacity building was that each phase and size in the development of the SMEs is complex and requires different support services and financing solutions. If you are working with a micro SME, you can't bring a high-level technical assistant from the US to work with them. You actually need to do step by step and to help them even analyze some of the records that they have. What do they mean? How do they affect their decisions? We also really realize that it's not one thing that solves the problem. We need combinations of training, BDS, technical assistance, and mentoring to effectively grow the SMEs. What we realized is where some of the SMEs would attend short courses, and then they would have some kind of mentoring, they would actually grow better because we are reinforcing messages as well. And the topics need different approaches depending on the size and skill sets within the SMEs. But basically, capacity building is needed in all aspects of the businesses, from product development, quality management, business strategies, marketing, HR, and financial management. In some of the SMEs, it's very easy to think they know what they are doing. But if you think of like SMEs that handle grains, if they don't handle the grain properly, we end up with aflatoxin cases, serious cases in the countries. If we are working with SMEs that work with agro dealers, for instance, if they don't handle the products, we end up with farmers disenfranchised on the use of the inputs that we would want them to grow. The other lessons we learned are that BDS companies need diverse ranges of skills. I know a lot of the ones we worked with, they would outsource in areas where they didn't have, but you still need a base of skills that will help you so that as you grow, you are not outsourcing too much. And the BDS companies need to be proactive and provide matchmaking activities. I'll use the example of the profit model. They actually had meetings of SMEs and financiers to actually sit and discuss and see what needs to be done. So those things are needed to actually facilitate the linkages to help them to work. But one other thing before I finish is that even when we are talking of the business development services, the targeting of who receives the training, who receives the mentorship, who receives those things is critical. We need to actually make sure that the people we are targeting are the people who do the work and who will be able to actually put this in process. Thank you very much. I think that is all from my side.
Thank you, Dr. Rufaro. To the audience, continue typing in your questions in the question box provided, and we will answer the questions during the Q&A session. The next speaker, we have Mr. Patrick Lumumba, who is a Senior Capacity Development Officer at the African Guarantee Fund. Welcome, Patrick.
Thank you. I'll pull up my presentation. Yeah, I hope you can be able to see my presentation. Alfred, confirm?
Yes, we can.
Yeah.
Excellent. Thank you so much, participants, guests. Because of time, I'll try and make my presentation highly summarized to allow for plenary session for Q&A. I know a lot of time has lapsed. This is a blended finance presentation from AGF perspective, highlighting also the complementarity between AGF and AGRA. Briefly, AGF formed in 2011, began operations in 2012, with a key mandate to facilitate access to financing to SMEs in Africa by provision of partial finance guarantees and CD. We are currently in 40 countries and growing. And as Frank mentioned, we are AA- rated by Fitch. What's the relevance of the rating? In addition to the credit risk mitigation benefit that financial institutions get, the rating also reduces the level of loan provisioning requirement by the regulators, which implies that there's a positive element on the bottom lines of profit of financial institutions. So it's a double-edged benefit for accessing AGF guarantee. I won't delve on blended finance. Ezra elaborated more on that, even the types of blended finance. But key on that is the characteristics of blended finance. Guarantee and CD in the case of AGF, it enables financial institutions to leverage. It enables financial institutions to mobilize, and it enables financial institutions to trigger private capital. Because as indicated, they're not there for forever. So the intention is to trigger, to showcase that certain sectors, certain population segments are bankable, and hence paves the way for capital or commercial finance to be brought on board. Secondly, is for impact creation. It's not just there for the sake of it, but what developmental aspects do they play in terms of job creation, employment creation, poverty alleviation, and such kind. And ultimately also, as any investor, there are modicum or moderate returns that they expect. So those are the key three aspects that any blended finance, like the model that we have at AGF, focuses on. We were created to sort certain gaps, as Frank indicated earlier. And in terms of aggregate lending, leaving alone the usual SME lending, agri-finance lending has major issues, both at the supply end and of course the demand end. At the financial institution level, there are information gaps. They require certain information from SMEs or agribusinesses, such as financial statements, while SMEs or agribusinesses don't have the format or the templates that are required. So AGF fills that gap through its CD support. Collateral gap requirements from financial institutions, especially if they hear it's an SME or agribusiness, the collateral requirements are super high. And at the other end, agribusiness don't have the collateral required. So there's a major gap. This is sorted out by an area of AGF guarantee products. Tenor gap, again, from a financial institution perspective, they tend to give short-term but high-yielding facilities. But at the other end, agribusiness especially, and smallholder farmers who rely on seasonality of their crops have totally different tenor requirement. So there's a gap. And again, guarantee facilities play a key role in mitigating this. At the skill gap, of course, lending to SMEs, worst of all, lending to agribusiness is a slightly different ballgame for financial institutions. And at the other end, you find that agribusinesses, smallholder farmers are not as financial literate. They don't have managerial skills. Again, our CD support comes to fill in the gap to that extent. Again, as we said earlier, banks have conventional products, the usual products that are less riskier. But you come to agribusinesses, their product requirement needs to factor in their seasonality elements and such kind of things. So there's a gap. So AGFCD plays a key role in looking at different value chains, players, their needs, and working with financial institutions to structure products that are able to cater for needs of the agribusinesses, but are also less riskier due to the capacity development that accompanies that. Perception gap is critical. Financial institutions have challenges previous and before, because some of them are coming from a corporate background or microfinance background. So there's a gap in terms of proper lending to SMEs or agribusinesses. And once they get there and they have a bad historical experience, it becomes very hard for them to get back to that space. And SMEs or agribusinesses also, once they've interacted with financial institutions and they get wrong products and they struggle to pay or even default and get their little collateral sold by the bank, they consider themselves slightly different. So again, our model of blended finance is able to sort the perception gap and bridge that gap. So our objective, of course, now is to increase lending to SMEs, agribusinesses, increase lending to new and financially neglected sectors. Agri, as you're aware, if you review most financial institutions' portfolio, if they're not agri specialized, you find that the portfolio within the agri or agribusiness is very small. The usuals are the trade and manufacturing. But this blended finance that AGRA is offering is going to facilitate a growth in lending to these neglected sectors, especially the agribusiness. And of course, reduce collateral requirements. Related to that is increased cash flow-based lending. Based on the capacity that the agribusinesses will be provided and the capacity within the financial institution, then they'll be able to have skills in proper analysis of cash flows and be able to lend based on that. And also provide longer tenor for agribusinesses, and of course through one of our guarantee products for financial institutions that are seeking to enhance their capital for on lending, then they'll be able to enhance their capacity or their capital for on lending through one of our fundraising guarantee initiatives. That slide basically summarizes our two-pronged or double-pronged blended finance model, where we provide an array of guarantee products accompanied by CD that support different players. I'll summarize the key elements of the 4 products that we offer. The flagship is the loan portfolio guarantee. We call it an LPG. An institution approaches AGF for coverage based on their SME strategy, or basically their broad growth strategy as an institution, and AGF is able to undertake a comprehensive due diligence on the institution. We know the areas, but specifically AGF, being a risk management fund, is able to focus on the portfolio quality over time for the institution. And more so, we dig deeper on the SME portfolio because that's where our risk basically falls in. And specifically, if the institution asks AGF to cover its Aggregate portfolio, then we'll further dig deeper to analyze the Aggregate portfolio over the period. And based on that, then we'll be able to structure a term sheet that can then lead to a guarantee agreement with the institution. The other product is a loan individual guarantee. In certain situations, a financial institution approaches AGF with a particular SME or agribusiness ticket that is slightly huge and probably cannot be accommodated within the loan portfolio guarantee itself because of limits. So in this case, AGF then undertakes a due diligence on the financial institution, but also reviews that particular credit application or credit paper, and is able to provide a cover for that specific agribusiness loan application. The other interesting product is a fundraising guarantee. We come across financial institutions that don't have adequate capital for on lending to their SME customers. So in this situation, when a financial institution has gotten a potential lender, a DFI or a bigger bank, and the bigger bank or a DFI requires additional level of comfort, then they can approach AGF to provide that level of comfort in terms of a fundraising guarantee, which then enables the financial institution to lend specifically to their SMEs. So this fundraising, the amount that they have raised targets specifically SMEs and not other sector. And then this enables them to provide slightly more longer term and medium term facilities. The last product is equity guarantee, and it targets private equity funds and investment funds. And it's where an SME has grown bigger and requires an equity partner, not just credit, but an equity partner to work with over a period of time. So this particular guarantee then gives some cushion to the private equity who's investing in an agribusiness, so that at the end of it all, it secures him when he wants to exit the agribusiness company, then he's reassured that whatever he had invested, he'll be able to gain it back. Our guarantees are partial guarantees, 50% coverage. It can be extended based on certain parameters. The other product that forms the last part of the blended finance is the capacity development. And CD basically facilitates it serves two objectives. One is risk mitigation largely, and secondly or secondary is business development. So risk mitigation, we target this particular CD support targets financial institution because we are aware, as my colleagues undertake due diligence on financial institution, they identify areas of needs within the financial institution. Topic of concern is the agri-business. So find that most financial institutions, of course, lack agri-business products. They lack staff training around agribusiness. So all that are identified if at all we are going to cover such a sector. So our CD comes on board to address those particular needs to ensure the financial institution is able to effectively lend to the agribusiness customers with reduced level of default and hence reduced level of claim on our guarantee. But it also serves as a business or market development to the extent that when we develop a product for a financial institution in Aggregate, or we undertake a value chain feasibility study to enable them to understand a particular value chain, then that's a business development objective of our CD. Also, when we work with BDS providers, business development service providers, and these are consulting firms, these are projects that are out there. They go out to identify, train, and mentor businesses. Then we're able to facilitate financial institutions to have more numbers of potential customers for whom they can lend to. Because usually some of the challenges that we have come across is that financial institutions say we are willing to lend to SMEs, but where are the bankable, investment-ready SMEs? So that's usually one of the challenges they come across. So our BDS initiative, seed initiative, enables us to work with financial institutions and create a pipeline of credit-ready SMEs that they can lend to. We have done this initiative. We are currently doing it in Nigeria. We are currently doing it in Kenya and Uganda. We have done it in Rwanda and Tanzania, and it's a model that is working pretty effectively with less and less NPL. So the other initiatives that we usually undertake under CD is what we call generic interventions. We go to certain countries when we want to launch new initiatives, either initiatives or guarantees that target women-specific SMEs, or initiatives that target youth-specific SMEs, or initiatives that are supposed to enhance lending in sectors such as green energy. What we do, either we study and provide a platform whereby the results of such studies are presented to stakeholders, or just undertake national conferences where we bring stakeholders together to discuss and demystify perceptions that are there regarding such sectors. We have done this in Zambia for green energy. We have done it in Ghana, Senegal, Cote d'Ivoire, Kenya, when we're launching our green energy support, green energy, green guarantee fund. And with that, you find that negative perceptions that were initially there get sort of demystified, and people appreciate that there are potential and profitabilities within certain sectors that were initially perceived as risky. So it's the same initiative that we can structure working with AGRA to do more and more forums that bring stakeholders together. Policy, DFIs, financial institutions, and agribusinesses, so that everyone deliberate on what challenges are there, what resolutions can be made, what solutions are there and available for us to enhance, demystify the negative perceptions and facilitate more and more financial institutions to lend to those sectors. We have also done it in partnership with UNDP for development minerals, whereby most financial institutions were not aware about construction materials being an area that they can fund. So again, understanding the value chain in those particular sectors is critical, and bringing stakeholders together to deliberate on the challenges and opportunities. So it's the other CD interventions that we look at. AGF in partnership with AGRA, there's a lot. As you've seen from AGRA's presentation, there's a lot of synergy, there's a lot of connectivity between AGRA and AGF. But more importantly, AGF, CD, and guarantee initiatives are at the upper level of the value chain, financing value chain. So you find that we support a lot of financial institutions, but we also come down to support SMEs to a large extent, especially through BDS and financial institutions if they have SME hubs. So we do that. But relying on AGRA's long years of experience in supporting agribusinesses, supporting smallholder farmers, providing farmer extension services directly is very, very critical, because again, financial institutions, the first thing they usually indicate is that farming is risky, especially at the production end. But AGRA, with its experience, is able to provide aspects managing seasonality, managing markets, managing weather, providing seedlings and farm extensions. So this is very critical. This particular partnership is critical towards that. And of course, AGRA's experience in working with governments, national and policy level. So again, this blend of partnership with critical for financial institutions intending to grow their agri lending space. But more or less also, AGF is bringing on board our AA- rating, which, as I said, has two benefits to any financial institution. Apart from the risk mitigation benefits, we are able to enable you to get lesser provisioning on your books, which implies more profitability for any financial institution accessing our guarantee. And of course, AGF also has experience in Africa in setting national guarantees. So as Ezra indicated, it's not AGRA's business to manage guarantee funds forever, but to pilot and leave it to institutions like AGF to take over, manage for the longer term. Of course, AGF is also bringing its rich experience in undertaking due diligence for financial institutions, and of course, the overall relationship management of it all. And we still have our FI, financial institution, and BDS CD provision, and critically monitoring and evaluation elements that we're able to bring on the table for this partnership to work. Our achievements to date, I won't go one to one. We are currently working with 161 financial institutions so far to date. Over 20,000 SMEs have benefited. I think that number can be multiplied severally to appreciate the number of beneficiaries that have gotten, but that have benefited from AGF guarantees, created 129,000 jobs. Through green guarantee, we've also had a lot of impact. Currently, it's growing. We are currently 11% of our portfolio. It's contributing to climate change mitigation and adaptation. So this is an area that also has a lot of connectivity with Greek lending. 60% of our portfolio are youth-owned SMEs benefiting from AGF facilities, and 30% of that are women. So these are two population segments that AGF is very, very interested in. And of course, we know the role that women play at the lower end of the Greek value chain. Last slide is our list of shareholders. Again, as indicated by Ezra and myself, is that they are catalytic. They bring in equity capital to facilitate the catalytic element in all this. So yeah, thank you so much for listening. Back to you, Alfred.
Thank you, Patrick, for that insightful presentation. We have now moved to the discussion time where we will have the questions that have been posted on the question box answered. Due to time constraints, we will not be able to pick the questions live from the audience. So rather, we will encourage the audience to write the question or type the question on the question box. Now to the first question. To Ezra, one of the big constraints of agriculture financing is the lack of good quality data in terms of understanding the risk and better pricing the risk. In your experience, how are we overcoming this constraint? Over to you, Ezra.
Maybe you could have asked 2-3 questions.
Okay.
We can pick them. Yeah, so that we don't pick 3-4 questions and we can pick them. I've noted it.
The second question is there evidence that guarantee schemes are bridging the gender financing gap? Third is your experience in Ethiopia with blended finance, particularly what was the interest and cooperation level of the central bank and local financial institutions? What are some of the challenges that you came across, and how did you overcome them? I think you can pick those 3 before we move to the next participant or questions.
Thank you. Data is a major issue across the board. Because in the absence of data, you cannot make good decisions. And in fact, that is why my colleague Hedwig had talked about our digital platform, where we're looking at issues of how can we get the data in a way that enables us to understand the SMEs very well. And we have tools that we are working with in terms of making what you call SME bankability. So that's an area that we're working on aggressively, AGRA. We are also discussing it aggressively with our partners on the way forward. How can we get scale without losing out in the quality of information that we're gathering? So that's an area that, yes, I think Hedwig may also chip in on that. Our experience in Ethiopia with Central Bank, maybe the program that we are currently setting up in Ethiopia is in its inception stage. But there's a lot of work, the precedence to this program, there's a lot of work that has been done with Central Bank in terms of giving them evidence so that they can treat guarantee as part and parcel of what can be lateralization. Because you find that in many governments, guarantees are not treated as part of collateral. Our role is to provide evidence that guarantees and the technical assistance de-risks the sector, and therefore that in itself becomes a collateral. We have in the program that we are designing is an active part that will be working on regulation. We'll be working directly with Central Bank of Ethiopia to provide them with technical assistance, as well as also provide them with data to make them more involved in the sector. So those are the two questions that I thought were directly related to this. The other one was
I would like to respond to the question related to the link between guarantee and gender women financing.
yes.
Definitely, the guarantee will have a great impact on the growth of the women financing. And to illustrate that, we are currently the implementing agents of a program called FOWA, Affirmative Action for Women in Africa. And this program, the guarantee part of this program is basically will help, I will say, to raise more than 1 billion USD to finance women business in the next 3 or 5 years. And how, what is the role, what role guarantee is playing in this program is that in Africa, most of the time, due to social or economic reasons, it's very difficult for women, or for most of the women, to access easily to financing. And this program is there to give comforts, to give capacity development, as well as to the bank, to the women business. And at the end of the day, it's also coming with many incentives in terms of coverage, in terms of tenor, in terms of pricing. So the answer to the question is yes. There is a clear link between the impact of a guarantee and the growth of on lending to women business. Over to you. Hello,
Alfred.
Yes.
Hedwig, do you want to chip in? Okay. Let me just add to the question on women empowerment. We have an example with AFC where we actually discovered that we need to develop a specific product that is targeting women, and therefore the guarantee was to cover that, because many women did not have land or titles for their collateral. So we developed a product that is relevant to women and youth that will use the guarantee as their sole collateral for lending. And so that's the way we are addressing it, the DFI.
Alfred, can you give us some new questions?
Sorry, I think internet connection challenges. Now this is open to the floor about TA for regulators, especially central bank. What is the experience so far in handling that?
I think I don't know, Frank, whether AGF has ever provided TA to a regulator before. But I think what happens is that through TAs provided to financial institutions, then what happens is that regulators are able to embrace, based on our work with banking associations or financial institutions themselves, the regulators are able to adapt to certain changes within sectors and the financial space. But in terms of AGF providing direct TA to regulators, I'm not aware. Frank?
Yes, to add on what Patrick is saying, we don't give a TA directly to regulator, but as we have our footprint in 40 countries in the continent and more than 140 banks and partner financial institutions, we advocate the regulator to highlight what is happening on the ground, and also we propose them some ideas. So at the end of the day, they are the regulator, and they use all the ground information to make the regulation. Thank you.
Maybe just to add to that, I have already indicated that in our program in Ethiopia, there's a specific grant that will be looking at providing evidence and working with the regulator to develop mechanisms and an environment that enables commercial sector to come in the ag business and the SME sector and use what you call alternative collateral.
Thanks for that, Ezra. There are a number of questions regarding partnership with AGF. How would organizations partner with AGF?
Very simple. They just have to send us a letter of request, okay? And from the reception of the letter of request, we will pick it from there. Okay, it's very simple process. The onboarding, letter of request, and from then we sign an NDA. They share some due diligence information with us. From them, we share an indicative term sheet with them. And when we sign the indicative term sheet, we go now deeper in the due diligence. And after that, we finalize our partnership by signing a guarantee agreement.
And I think to add on, Alfred, on what Frank has said, I think at the end of the webinar, such requests you'll just forward to us so that the relevant regional teams can be able to follow up on such requests.
Okay, we move on to our last question to Dr. Rufaro. Are there any lessons learned on how the MSMEs are connected to large off-takers or end buyers?
Yes, of course, there are lessons. We have seen in Ghana some small SMEs connected to larger off-takers. We have seen in Mozambique some small SMEs connected to large off-takers like a Billion Tunes, New Horizon, ETG. What they do is the large off-takers actually insist on their on their quality standards. They have given the NGOs and the people who are training the SMEs their quality standards. What are their standards? What are their requirements? So the SMEs are trained on that, and once they can actually produce the quality, then they can buy from them. What has happened in some of the places is some of the larger off-takers actually give money to the smaller off-takers so that they can buy from the farmers, from the CBAs or VBAs, and then pay cash, so that there is actually no loans in the process. So it's a system that is funding itself in some cases. But yeah, those are some of the lessons that we are getting, where if the large off-takers like the New Horizons, the Billion Tunes, may actually give a bit of funding, give a bit of funding to some of the smaller SMEs so that they are able to aggregate and produce the quality. But it works on a trust basis. It works on a relationship developed basis for them to be able to do that. So that's what we have so far. It's still quite small. We are really hoping that it can actually grow, because once you can actually have a self-funding system within the ecosystem, then we avoid a lot of other running around looking for money everywhere, especially for the small SMEs. Thank you.
Thanks for that, Rufaro and team of panelists. Some of the questions that have been left unanswered, we are going to package the answers and send them directly to the people who have asked the questions. Due to time constraints, I think we are moving towards the end of this webinar. I will now invite Dr. Frank of AGF to give his closing or parting.
Thank you, Alfred, but I'm not a doctor. This was a very interesting session.
Mister.
Yeah, this was a very interesting session, and the synergies between AGRA and AGF's guarantee schemes and capacity development services will definitely will definitely prepare the farmers to bridge all the gaps that they are facing, and will help banks and financial institutions to reduce also all the gaps that we have identified by sharing the risk also with AGF. So my last word is that I want to call all the banks and partner financial institutions who are attending to this webinar to take one simple action right after this session. This action is just to send a letter of request of guarantee to AGF, and in order to leverage on the advantages of our guarantee products and the synergy that we are building with AGRA. Over to you.
Thanks so much, Frank, and over to Hedwig. Your closing remarks, please.
Thank you, all of you. Thanks very much for all the presentations. I think it was really enriching and interesting to see the different perspectives from AGF and AGRA, and indeed, there's a lot of synergies. I have 3 ways forward and 3 things call for action for all of us, including AGF and AGRA. I think the first one for me is let's try and get our governments, our African governments, to invest in blended finance, right? Instead of using their money for spending on subsidies, maybe they can consider investing them in de-risking instruments to leverage private sector capital, so to get more value for the same money they have. So that is something I think we can do together with you, AGF. The second one, I think we're both into capacity development. I think we both have a big interest to try and see how we can reduce the cost and the effectiveness of business development services and technical assistance. How can we use digital tools? How can we automate? How can we scale? What type of tools and systems do we have that can really make the cost of technical assistance for the banks and BDS for SMEs cheaper, so that we can do more with the same amount of money? And as said, I think we are there to support you in the capacity development you do with banks and SMEs where it comes to agricultural specific things. In AGRA, we've developed some financial models that banks could be benefiting from while they use your guarantee to further de-risk their portfolios. The third one, a call for action I wanted to, is maybe a call to AGF. I think in agricultural finance, it's not only the banks that finance. Most of the time it's companies that finance other companies. So there's a lot of supply chain finance within agriculture. So I would call for action for us to look into the possibility of how we can create guarantees to de-risk transactions between companies. I mean, that is a complete new line of business, but I think we need to always look for the new cutting edge, innovative things on how to do things better. And one of the new things I think we need to look into is how can we de-risk transactions between agricultural companies. That's a way forward for us both to collaborate in the future. So thank you very much, all of you, for attending this webinar. I think we have an agenda with 3 important points, which we can scale and elaborate on in future webinars, seminars, meetings we are going to have online, offline. I invite you to AGRF, which is in 2 weeks' time. We will have plenty of time to discuss these topics. There's a lot of sessions on inclusive finance, on innovative finance, so please welcome to AGRF. And thank you all and have a good afternoon. Thank you, colleagues from AGF and AGRA, for attending the webinar, and see you next time.
Thank you.
Thank you very much. This is just the beginning of many interactions to come. It's not the end. We are going to share the presentation slides with the participants. And as the parting shot, as speakers have said, this is just a beginning. Keep on talking. If sending the letter of, or rather the expression of interest, let's do it. Let's look at how do we support, how do we enhance finance going to the agriculture, to agriculture in our respective countries. Thank you very much, and see you again soon. Thanks.
Thank you. Bye-bye.
Thank you, everyone, for attending.